Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of all the complicated financial mumbo jumbo. So you don't have to in this video. We will dive into the Gladstone Alternative Income Fund's latest quarterly report and see where all the money is going. Gladstone Alternative Income Fund. A player in the investment world has just released its financial report for the period ending the 30th of September 2025. While the report covers a lot of ground, we're going to zoom in on the most important bits, the numbers that tell the real story of how this fund is performing and where it is steering its investments. Before we jump into the juicy details, if you like getting these kinds of clear, no-nonsense breakdowns of corporate reports, make sure you hit that subscribe button. And hey, we've got a growing community over on Discord discussing these filings, so join us there too. Link is in the description. First up, let's talk about how this fund is run. It is managed by Gladstone Management Corporation, and they're not exactly working for free. The fund pays them a management fee, a base amount that adds up, and an incentive fee that kicks in when things do well. For the period ending the 30th of September 2025, the advisor earned significant base management fees. We also see that the advisor is contractually agreeing to reimburse some of the fund's expenses. It's a complex setup, but essentially the manager's pay is tied to the fund's performance and assets. Now, let's get to the heart of it all, the financial performance. For the 6 months ended the 30th of September 2025, the fund reported a net investment income of over $675,000. This is the money the fund is making from its investments after covering its operating expenses. It's a positive number, which is good, but we need to see how this stacks up against its peers and its goals. Looking at the income side of things, the fund brought in over $920,000 in total investment income. This is made up of dividend income and interest income. Interest income is the big driver here, accounting for the vast majority of what the fund is earning from its loans and debt investments. On the flip side, the fund's expenses are also substantial. Total expenses for the period were over $1.4 million. This includes administration fees, professional fees, and various other operational costs. However, a significant portion of these expenses, over $1.1 million, were waived or reimbursed by the advisor. This is a common practice to help new funds get off the ground and keep expenses low for investors initially. Without these waivers, the fund's actual cost to investors would be much higher. When we look at the gains and losses from investments themselves, the story is a bit different. The fund saw a net change in unrealized appreciation of investments totaling over $251,000. This means the value of some of their investments went up on paper during this period. However, there were no realized gains or losses reported, meaning they didn't sell any investments at a profit or loss during this reported 6 months. Overall, combining the net investment income and the change in unrealized appreciation, the fund saw a net increase in its net assets from operations of over $926,000. This indicates that during this period, the fund's operations generated more value than it spent. Let's dive into the actual investments. As of the 30th of September 2025, the total investments at fair value were a little over $29 million. This represents a significant stake in a variety of assets. It's interesting to note that the total investments represent 1941.19% of something, which with liabilities in excess of other assets means the fund is leveraging its capital. A significant portion, over 27%, is held in cash and money markets. This is like the fund's checking account, offering safety and liquidity, but not much in terms of growth. This high cash position might suggest caution or a strategy to be ready for new investment opportunities. However, the core of their strategy and the largest chunk of their investments is in direct lending, making up a substantial 61%. This means they are directly providing loans to businesses. Looking at the breakdown by industry, aerospace and defense is a notable area, making up over 21% of the portfolio. This is followed by food and tobacco at about 11% and healthcare, education and childcare at over 10%. Drilling down further into specific holdings, we see companies like Detroit Defense, where the fund has invested in secured first lien debt. This is a type of loan that is high on the priority list if the company runs into trouble, making it generally safer than other forms of debt. A significant chunk of their assets, over 27%, is in the Morgan Stanley ILF government portfolio. This is essentially a money market fund, which aligns with the high cash allocation we saw earlier, providing stability and easy access to funds. The report also includes performance data. For the 6-month period ending the 30th of September 2025, Class's shares returned about 3.36%. This is notably lower than its benchmark, the S&P 500 Total Return Index, which saw a return closer to 13.9% over the same period. This suggests that in this particular period, the fund's strategy did not keep pace with the broader stock market. However, it's important to remember that these are different asset classes with different risk profiles. The schedule of investments shows the breakdown of the fund's holdings when it comes to value. The total investments at fair value are what we looked at before, around $24.5 million. The debt investments alone are valued at over $13 million. These are primarily loans to various businesses. A substantial portion, over $8.9 million, is in United States Treasury bills. These are considered among the safest investments in the world, offering a very low rate of return but virtually no risk of default. And then to raise the short-term investments category, which is about $4.9 million, mainly in a money market fund. This confirms that a good portion of the fund's assets are in very liquid, low-risk holdings. All of this leads us to the fund's net assets, which stood at just over $20.8 million as of the 30th of September 2025. This is the value of the fund after all liabilities are subtracted from its assets. It's also broken down by share class. Class I shares represent the largest portion of these net assets, over $20.5 million. In fact, Class I shares are what the vast majority of the fund's investors hold. Now, for some potentially tricky terrain, the report details how investments are valued. A significant portion of the fund's investments, over $15.5 million, are classified as Level 3 assets. This essentially means their value is based on inputs that are not readily available in the market and involve significant judgment. This can include things like company earnings forecasts or expert opinions, which can be more subjective than market prices. For these Level 3 investments, the valuation techniques used are primarily yield analysis and a total enterprise value or TEV approach. For example, the discount rate used in the yield analysis for secured first lien debt ranges from 11.0 to 12.9%. For equity investments, the TEV is based on EBITDA multiples, which can range from 4.1 to 6.7 times earnings. When these unobservable inputs are used, their impact on the fair value can be quite significant, meaning that changes in these assumptions could lead to notable ups and downs in the reported value of these investments. Looking at the tax basis for investments, the cost of investments for income tax purposes is reported at over $29 million. Importantly, there are no capital loss carryforwards. This is generally a good sign, suggesting that the fund has not incurred significant capital losses that would carry over and offset future gains. Let's touch upon who's getting paid. The trustees, the people overseeing the fund, received a total compensation of over $31,000 for the fiscal year. David Gladstone, who is also the chairman and CEO, and Paula Novara are listed as interested persons because they are also officers of the fund and work for the investment advisor. And speaking of David Gladstone, he wears quite a few hats. He's the founder, chief executive officer, and chairman of several related companies, including Gladstone Capital Corporation, Gladstone Investment Corporation, Gladstone Commercial Corporation, and Gladstone Land Corporation. He's also the founder, CEO and chairman of the advisor, and a board member of the distributor. This interconnectedness is common in the financial world, but it's always worth noting how many roles one individual plays across different entities. Then there are the officers of the fund, like John Satiri, the president, Michael Malazardi, the treasurer and chief financial officer, and Michael Lacolsi, the general counsel and secretary. They all have extensive experience within the Gladstone family of companies. Finally, a quick note on privacy. The fund states they are committed to protecting shareholder information and will not share it with third parties unless legally required or for essential business operations with service providers. They don't rent, sell, or trade personal information. It is good to see a commitment to data privacy, though, in the world of finance. Information is always sensitive, so what's the big picture here? The Gladstone Alternative Income Fund's report for the 30th of September 2025 shows a fund actively deploying capital primarily into direct lending, with a significant portion also in stable assets like US Treasury bills and money market funds. The fund is leveraging its assets to amplify returns. A considerable part of its portfolio is valued using Level 3 inputs, which means investors should be aware of the inherent subjectivity and potential volatility tied to these valuations, while the fund's net investment income is positive and expenses are being managed. Its performance over this 6-month period trailed behind the broader S&P 500. This isn't necessarily a bad thing, as the investment strategies are different, but it's a point to consider when comparing its returns to market benchmarks. The extensive roles held by key individuals across multiple related companies highlight a coordinated but potentially complex management structure. Overall, the fund appears to be executing its stated strategy of focusing on income generation through debt investments, while maintaining a degree of conservatism with its cash and treasury holdings. The key risks for investors would likely stem from the valuation of its level 3 assets and the potential for its chosen investment classes to underperform broader market indices in certain economic conditions. Alright, that is our deep dive into the Gladstone Alternative Income Fund's latest filing. What is your take on these numbers and what they signal for the company's future? Do you think the focus on direct lending is a smart move, or does the reliance on level 3 valuations raise a red flag for you? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us out, and of course subscribe for more in-depth corporate breakdowns. Don't forget to check out the Discord community linked in the description for more discussions. Thanks for watching, and we'll see you next time on Corporate Decoder.